David, you've been a long-time Fed watcher. What stuck out in terms of what you heard yesterday?
Well, I think one thing that's interesting, and Steve mentioned it, I think it was in the Journal, that they didn't seem to want to talk about monetary policy to the extent that they weren't scoring points, which of course is what members of Congress do. They were really focusing on the Fed's regulatory side. There was a lot of criticism of the pending bank merger, BB&T and SunTrust. There were concerns about whether the Fed is doing what Congress wants to ease some of the regulations and capital requirements on the mid-sized banks and stuff. So I think, and that's not surprising, you know. At the moment, most of them don't have any complaints about monetary policy, so they're using the forum to kind of push the Fed in the direction they want on regulation. The Democrats to be tougher on the banks, the Republicans the opposite.
What do you think in terms of what you heard, Swagel, Mr. Swagel?
Oh, sure. Yeah, I mean, like David, you know, the lack of focus on monetary policy was striking, and we'll see more of that in the House. I mean, just by its nature, the House is just more diffuse, the concerns. So there's going to be some, you know, some frankly random questions, and that will be the challenge for Chair Powell is to figure out what the underlying question is. Maybe if something's not well posed. But I think he showed yesterday that he's actually really good at this testimony and addressing the concerns. So I think today will go well. It'll be interesting, but it'll go well.
David, how do you expect this inflation targeting debate to play out? How does Powell finesse this issue of he's not hitting his target, he has to do something, but the thing he might do could create a political firestorm?
Well, I think the Fed has made pretty clear that they're not going to raise the inflation target above 2%, even though there's some advice, mostly from academic economists, that they should. They seem to be moving towards this notion of an average of 2% over the business cycle, which is another way of saying that when you have a long period, as we have, when inflation is below 2%, they're going to tolerate, maybe even encourage, an offsetting period of inflation above 2%. That's what John Williams has been pushing, the New York Fed president. And I thought Rich Clarida has spoken, the vice chair, favorably about it. And I thought Powell was kind of opening the door to that. And the advantage of that is it helps them get away from the problem that you identified. They don't want to be below target. They don't want interest rates to be too close to zero. But they really don't want to challenge the bedrock of the Federal Reserve Act, which says price stability, which now, like it or not, is defined as 2%.
Hey, Phil, let me ask you something from another guest we spoke with earlier today. Peter Bookvar had this idea yesterday that the Fed has kind of added a third mandate, and that's watching the markets, making sure that there's not too much market volatility. He said just based on the opening statements where Fed Chair Jay Powell said that they paused largely because of movements in the U.S. financial markets. Secondarily, he said weakness in both Europe and in Asia. Do you think that that is a stretch? Do you think that's legitimate?
Oh, well, yeah, no. I was
sorry, Phil first and then David.
Sure.
Yeah, no, I was pleasantly surprised that Jay Powell was so upfront about that. They clearly paused because of the markets. You know, I'm not quite as strong as your previous guest that this is now like a third leg of their mandate. You know, it was a one-time situation, right? The decision to hike was pretty close in December. They probably got it wrong, and in some sense they're acknowledging that. I don't see them paying heed to the markets and, you know, in the future necessarily.
David?
Well, I think that the Fed has added a third mandate, but I wouldn't frame it the way Peter did. I think the third mandate is financial stability, and that's why there's so much talk about things like leverage lending and stuff like that. Look, the Fed has always paid attention to the markets, particularly when there are big moves. Monetary policy works through financial conditions. There was a change in financial conditions. You'd be foolish not to see some signal from the markets, a change in pessimism. Maybe they've changed their mind, but it's a very delicate dance. On one hand, you want to take signals from the market. On the other hand, you don't want to create what we used to call the Greenspan put, and Powell doesn't want to create the Powell put. Whenever the market goes down, the Fed backs off. So they want to say we see information from the market. We compare that with other signals we get from the economy, but we're not making keeping the market high or stable one of our primary objectives.
Phil, I'm sure that you want to spend the rest of the time we have here defending modern monetary theory, right?
Boy.
I mean, I'm sure David is bemused that we're even talking about this. He's been around so long. But Phil, I just want to ask you this idea: we can just print money, right? I mean, what's wrong with it? It sounds pretty good. We sort of did it during the financial crisis, right?
Right, exactly. You know, we did, and for good purpose, and the Fed acted. You know, Paul Krugman, of all people, has just been spectacular lately on this in the New York Times. And he's just got it right, that, look, eventually we'll have inflation, and if eventually we'll have to deal with that. And the consequences won't be pleasant, right? If Jay Powell has rising deficits, rising interest rates, and rising inflation, he and his colleagues will have to really tighten on monetary policy, and that would be really not the thing we want.
Yeah, but David, Phil has that ever so slightly wrong in that if you print money, there's no deficit, right?
No, I don't even think they argue that. But the thing that they forget to mention to people is their theory says that if the economy overheats, if we start to get inflation, then we're going to rely on Congress to raise taxes and cut spending, rather than the Fed to do the management of the economy. And there's no reason to believe that would ever happen. I think one of the problems here is that modern monetary theory has gotten a little bit mixed with something which sober economists are talking about, which is if you believe interest rates are going to be low for a long time, then there's less urgency about reducing the federal debt to GDP ratio, because you're more likely to grow your way out of it. It doesn't mean that we should be running big deficits now. It doesn't mean that you can get a free lunch. But there is less urgency about reducing the current level of the federal debt if you believe that interest rates are low and are going to be low for a long time, not because of the Fed, but because that's where the natural rate of interest is.
Hey, Larry, let me just go back to you. From an investing perspective, if this is true, if the Fed really has added a third mandate, and that's financial stability, what does that mean for the markets? Does it mean that they will be able to more easily collar the Fed and push them into doing these things? Does it mean that it's simply something the Fed's going to be watching, or at least maybe more admittedly watching than it has? Maybe it's always been this way. What do you think?
I think it's somewhat dangerous if it gets to the point, as discussed in many of the conversations in the last couple of days. In other words, I don't think over the long run that's where their concentration ought to be. And I think if it is, it means more mercurial stuff and something that I don't think is in our best interest.
David, do you think that this is really a change, or I'm a little confused? You said it sounded kind of like the Fed's always been doing it anyway.
No, look, I think we got to separate something. When I say financial stability, I don't mean keeping the stock market from being volatile. I mean looking out for all the things that led to the worst recession of our lifetime. Banks that are over-leveraged, capital ratios that are too low, a failure to regulation and supervision. So things that that there's been a lot of discussion about. Bernanke set up a separate unit of financial stability to basically ask the question, what could go wrong and how can we be prepared for it? How do we make the system more resilient? That's not about keeping the stock market from going up and down. That would be crazy.
That's an important distinction.